As mentioned, hiring in the United States picked up in December. 256,000 new jobs were added, which is higher than expected, which was about 165, and the strongest pace of job growth since March of 2024. Investors are questioning how the data could affect the Fed's rate path. Let's bring in David Dietze. He is a chief investment strategist at Dietze Wealth Management Group. Hi, David. Thanks for joining us.
Mark, good morning.
All right, so we get much stronger than expected U.S. Jobs. We're also looking at the market betting on the Fed not cutting now until October. We've got bond yields moving up, stocks down. What's your overall view here?
Well, today is a classic case of good news for the economy is bad news for the stock market. Of course, as you noted there, it is diminishing the chances that we're going to see any further rate cuts from our Federal Reserve. And it's that classic, the higher interest rates are, the lower the present value of all assets, the more attractive bonds are at the margin relative to stocks. And I think you're seeing that play out in today's market. But I would caution you that, the job market is two things. One is it's just 1 month of data. We have typically seen many revisions in the ensuing months of the original data that was shared with us this morning. And of course, we don't know what January and February is going to bring. My own sense is that there was a tremendous surge of confidence following two things. One is the Republican sweep in the elections, deemed generally to be slightly better for the economy and for the markets, A, and B, there was a decision. We didn't have to have a long drawn out question mark as to what the results were. And I think that translated into confidence from this consumer. We just heard from Delta this morning. People are spending, and confidence on the part of business to go out and execute those hiring plans. But we got a lot of information ahead of us as to whether that's going to continue. And so I think investors basically should play the longer game and not overreact to December's numbers.
Now, David, you point out that the S&P 500's earnings yield, of earnings to price as opposed to price to earnings, is negative to the 10-year and has been for quite a while. And you call that ominous. Why?
So basically, people expect to get a better return on stocks because they're taking more risk. They're the last ones in the food chain when a dollar comes into the company. And historically, we've seen, as a result, earnings yields be 1%, 2%, or even more relative to that 10-year Treasury. Now, unfortunately, that earnings yield is negative relative to the Treasury. So that is a very cautionary sign. Now, how do we move forward on that? I think it's a couple things. One is a lot of the overvaluation is just in the tippy top of the S&P 500. It's those mega cap tech stocks. And by all accounts, particularly according to the tech cheerleaders, of course, we're in a new era relative to AI and what that can mean for productivity. These companies are less cyclical. They have great secular tailwinds. They have less debt. They're just behemoths that can justify higher valuation. The answer for investors, well, you can look beneath that. If you strip out the top 10 stocks, your earnings, your price to earnings ratio is much less, so that it's less of a concern. I'm not saying it goes away entirely. That's better. And of course, from an American investor's point of view, you can go overseas where valuations are almost twice as attractive as they are here. So I'm urging investors to rebalance a little bit, take a little bit off the mega caps, a little bit more fixed income, smaller companies, and maybe dip your toe in overseas markets.
All right, let's look at three of the names that you're interested in here. Looks like two of them are distinctly contrarian ideas. Paramount Global, that's a stock that's down 73% the last 5 years, 24% year over year. Is this a big bet on the Ellison family and how they're willing to spend?
Yeah, absolutely. So, Ellison family, one of the wealthiest on the planet. And of course, they play to win. Just ask anyone who's watching the draft picks of the University of Michigan versus LSU. And so they've made a big investment, and the deal has not closed. There's some uncertainty, but the Skydance should be taking over essentially Paramount. perhaps in the middle part of the year. And indeed, if that all comes out, they're going to offer at least half the investors a chance to cash out at $15.50 per share for what's now trading for 10 and change. That looks pretty attractive. Of course, they wouldn't be paying that if they didn't think that the value was there. This is a storied brand, of course. You've got the Paramount Studios, you've got CBS, you've got Nickelodeon, MTV, a whole host of brands here. And I think when the Ellison's coming in, debt and financial challenges no longer a concern with their kind of backing. So I think this is the time to dip in, take advantage of that big discount over the last few years, and I think you could be well rewarded.
Another name here is CVS, the pharmacy chain. Are you looking for value here? This one, another one that's had a rough time of it the last year, down by 41%.
Yeah, absolutely. So I think there's two things going on here. The key thing that gives you the opportunity now is the government is, of course, looking very hard at the role of so-called PBMs, pharmacy benefit managers, and whether somehow there's non-competitive actions because of the highly concentrated part of the business. CVS has a very important one that they got through the acquisition of Caremark and so forth. So people are wondering what's going to happen with that, which has supplied a large part of their products. But remember, what I like about CVS is right in the middle of healthcare. They're one of the largest pharmacies in the country, them and Walgreens, of course, with about 10,000 stores. Plus, on top of that, they own Aetna, which is one of your largest insurance companies, health insurance companies. So they cover all the various spaces, and the stock has come down. As you note, we think that even if you take a 25% haircut to the value of their PBM business, at a multiple of 15, you can still get $60 a share from that, which is very attractive. We, of course, just heard from Walgreens this morning, their key competitor. Walgreens seems like they're turning it around. CVS pharmacy stores in the same business. That also bodes well, which is why you see CVS responding very well this morning.